Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Eversource Energy, ticker ES. Over the next few minutes, I'll discuss both the valuation of this company and its business quality. We can see the company has a market cap of $29.3 billion, enterprise value of $49.1 billion. So you can see about $20 billion in net debt on this business, making up about 40% of the overall enterprise value. That's quite significant even for an electric utility company. As we dive in, we can see a little bit more details on their business. So they have both electric distribution and transmission. They also have natural gas and water distribution segments. So they're operating not just in electricity, but natural gas and water as well. That does mean that they're a little bit more diversified, but they're probably focused on the same customers for all sets of those processes. So they have the transmission and distribution of electricity. It doesn't look like they generate electricity. It's basically a distribution segment. Distribution, I think, tends to be probably a little bit of a better business than generation when it comes to utilities. And so that is good to see because you get to charge a lot more consistency on your fees. They are serving in the Northeast, Connecticut, Massachusetts, and New Hampshire, 226,000 customers. And that gives you a little bit of background there. Beta of 0.48, being below 0.5 is significant. That means it's at least half as volatile as the average S&P 500 company. The lower the volatility, that tends to be better for the overall business return for shareholders. It means to be a little bit more predictable. So I'd love to see really low beta numbers. Now, what's interesting when you look on this return on invested capital chart is you see a dislocation in 2005 and 2006, but I'm guessing this is some one-time items here because on a normal basis, if we just look from 2007 onward, this company is profitable each and every year, and it's a very, very stable return. You see very little variation in the return on invested capital. The less it jumps around, the more predictable it is to you as a shareholder to predict the future, and a lot of what we do as investors is try and predict the future, so I like to see very little variability here. So you see 3.6%, 3.3%, 3.9%, 4%, 4%, 3%, 4, 4, 4, 4, 4, 4, 4, 3, 3, 3. So these numbers are low. You can see they're not really getting above this 5% line. I would love for them to be above the 10% line. So they are in that 3 to 4% range. The positive end here is although those are low numbers, they're very, very stable, and that stability is going to be important because you have this high debt, and the high debt, the only way you can functionally work with very large amounts of debt is if you have a stable return that you can use to leverage that up. Now, they do turn this 4% return on invested capital into 8.5% return on equity. This number is still kind of low for me. I really want to be in the double-digit returns for me as a shareholder, which means I need my return on equity to be above 10%, ideally above 15% in order to get me a 10 to 15% return as a shareholder. So we are a little low. What this means right off is that this is a relatively lower quality company, and so the way that you'd want to play this is more of a trade depending upon valuation, depending upon setup in the marketplace, instead of a long-term hold, because when you have a lower return on equity, your long-term hold is going to be capped at the incremental return on equity. Now, you could start to get very high incremental new returns that would raise that return on equity over time, but that's really hard to predict, especially when you see the stability here. You're not seeing a slow and steady increase. You are seeing a relatively flat line, so we shouldn't necessarily predict the future to be much better than the past. So if you're comfortable with 8.5% return on equity, then this could be a really interesting idea still, but if you really need higher returns, you're going to be probably looking further than this. The next downside here is really valuation. PE of 21.1 is quite high for a business of return on equity of 8.5%. Now, one thing that you can look between the difference between PE and price to book here is the PE is trading based upon the fact that they're growing. They're growing at 8.2% per year, 12% asset growth, 4.8% EPS growth. This is growing in line with your return on equity. You can achieve this consistently, assuming they're returning all their money back to shareholders. What I would guess is, though, that we're probably taking on more debt over time. You're probably taking on issuing shares over time in order to fund this. Now, it's not required because they have gotten the return on equity up high enough to justify this sort of growth. But it's pretty typical for a company like this in the electric utility space. So that would be something I expect to see once we dive into the income statement. But when we look at the price to book ratio, you see 1.9 here. A quick, easy rule of thumb is that, you can divide the return on equity by the price to book, which is basically 2. And so you say, okay, then the return on equity of the current price would be something like a 4.2, 4.3%. And that would match pretty close to what we see here is the 4.5 to 5% current earnings yield. So these are matching up. And what that tells us is that this is probably the most recent year earnings is reasonable and something you could rely on as a baseline going forward, $3.54 per share. What it does mean, though, is you'd probably want to get it at a cheaper price because you're getting a low return on equity. I would actually like to buy this below book value, which would mean something along the lines of, cut this number in half. And so maybe you're trading in the $40 range instead of the $85 range. That starts to become a lot more attractive from an investor standpoint that's trying to seek those double-digit returns that I like to do. Again, you need to judge for yourself what your returns are, but that's how I look at it myself. Now, return on revenue, you do see the revenue growing by about 50% over the course of the decade. You went from 6.2 billion up to 9.8 billion. That's a pretty good growth rate. You see the revenue growth here at 8%. I think that overstates it a little bit based upon the numbers I'm seeing here. Actually, no, that's about right. No, that matched. But, well, I would expect an 8% growth rate to double at least every 10 years. So I would expect the revenue to be in the 12 billion range. I don't really know why that doesn't match up with my expectations. You have almost doubled your gross profit. You're up about 50% on operating profit. You close to doubling the EPS. So maybe I've been wrong on the share on dilution, but you are paying a decent amount in dividends. And what this does tell me is you're probably going to have some sort of other raising capital, because the only way you can pay out such a high amount of your dividends while still growing at this rate would be having to pull in excess outside capital. To do that, it's not ideal. But if you're enjoying this video so far, if you're learning something, please hit that like button. Don't forget to subscribe. I really appreciate that. And at the end of this video, I'm going to have a link to my favorite companies that I've already covered in the S&P 500. These are my watch list stocks. So that playlist will be at the end of the video. So an income statement. The income statement here is showing, basically closer to that doubling of revenue. You can see the trailing 12 months numbers. The numbers have jumped up significantly, so that kind of solves the problem I was looking at. We are about doubling our gross profit numbers. So basically, it's just telling us that what we saw on the overview page does play out, and so that still works. From a net income line, though, you do see this more than doubling, which is actually a good sign, because this is better on it than you would expect based upon the numbers we saw above. Because this 4.8% EPS would suggest you're not even doubling over the course of a decade. But when we look at the income statement, we can clearly see they doubled over the course of a decade. You're at $4 per share. You were at $1.89. That's more than doubling. So it means your EPS is better than it looked like on the last page, where you would say, oh, maybe this is something closer to 7 to 8% EPS growth based upon the numbers we're seeing. However, the net income more than doubled. 1.3 times, or 2.3 times, something in that range. But the reason that the EPS is not growing as fast is because they do have the dilution that I expected. You basically diluted an extra 20 to 30% of your shares outstanding at the beginning of the decade, and that's what's allowed them to grow. And that's going to be a 2 to 3% EPS drag over the course of a decade. You had 10% plus net income growth over the course of this decade. However, you had it dragged back down to about the 9-10% range because of this dilution, and that's not unheard of because that's how they're funding the growth that they're getting. They would not have a PE ratio of 21 with these return on invested capital numbers unless they were growing at these rates. So the management has a tough decision. Do they grow at the rates that make their stock at a good price, or are they disciplined with shares outstanding? And they've chosen not to be disciplined with shares outstanding. Obviously, you can make it work either way, but a lot of investors like growth, so that's what you're seeing there. The downside is when you see something like PP&E here. You've gone from $10 billion in PPE to $30 billion in PPE. So you've tripled your assets, but you've not tripled your earnings. You've not tripled your revenue, which means that over time you're getting worse and worse on your operating leverage and your return on assets. Not a good setup to have over time. And you can see it just very stark, easy tripling number here compared to the numbers we saw in the income statement. Not how you'd want to see it. In addition, they've almost 4x'd their long-term debt. mean, if I take this, say this 4 billion to 16 billion would be a 4x in debt. So you've tripled your assets, you're 4x your debt, you've less than tripled, and you've less than 4x your income. That cannot continue forever, which means it will stop at some point. And as it stops, shareholders will get worse returns than they've gotten in the past. So it's something to look for as a potential shareholder. You're trying to look at those signs that could be little red flags for you before you make an investment. One thing that you need to notice here is just look at the sheer amount of PP&E investment and how a lot of years it exceeds cash flow from operations, and that's a very bad sign. So you see, let's say 1 year, so they have more cash flow there, more cash flow there, more cash flow there, more cash flow there. They didn't here, they didn't here, they didn't here, they didn't here. So 6 out of the 10 years, they actually put more money into the business than they pulled from cash flow from operations. But instead of saying, hey, we can't pay dividends because it's taking more of our cash than we can produce, they said, oh, we're going to pay out a dividend and we're just going to raise debt to pay the dividend and cover the difference in the PP&E. I really don't like that setup. It's, again, common for companies with low returns on invested capital. They feel like they have to invest. Maybe regulators require them to invest, but it's why they're getting low returns on that capital, which means it's basically an illusion that they have the ability to pay these dividends. They don't. They cannot pay these dividends and fund their investment program, and that investment program is earning a low return. What that means is if you're investing at a 3 or 4% rate of return, you just cannot expect high returns as a shareholder. The only reason you can make this work is if you have low cost of debt, low interest rates, that sort of thing. But as we've already seen, interest rates have started to go up in 2022. They're probably going to continue going up in 2023. And so when you have higher interest rates, this sort of setup gets really, really bad. And for me, I would avoid Eversource Energy for that reason. If you enjoyed this video, please subscribe. And at the top here, we have a playlist. All of my favorite companies for the S&P 500 that I've already covered. I think you'll enjoy those. These are the watch list companies that I think are the best. And again, subscribe. Until next time, stop paying fees, start building wealth.